I say that to rev us up with some energy. But thank you so much for joining us. And I think this is a conversation that many of us pay attention to, right? Because we read about it in the headlines. Consciously, we're also well aware of what it is that we need to do from an investment and environment and sustainability and social investing point of view. But when we're looking for the numbers and the earnings, we're all well aware that within the global climate and context of things, ESG investments have really had to work for their rewards. And that's in light of the energy crisis that we witness, of course, overweight investments into the tech space as well, which have since waned in terms of a performance, which has raised the question, how do we follow through with ESG investments and how Old Mutual Investment Group is positioned for this one? Perhaps let me start off with you here, Fawaz, together with yourself to get some insight into your particular portfolios, how it is that they essentially do incorporate ESG in terms of your positioning and taking into account the current macroeconomic climate. Fawaz?
Yes, thanks, Gugu. Lovely to be here. So I belong to the investment team that manages the active ESG fund. We really incorporate ESG in a number of ways. The first one is we screen out particular companies that are sort of not in ESG compliant industries such as alcohol, tobacco, fossil fuels in South Africa, gaming, weapon manufacturing. So that's one way of incorporating ESG. We take those companies out and we do not invest in them. A second way is taking ESG and using it as part of your investment thesis when you're valuing a stock, saying, we believe ESG cognizant companies or companies with high ESG profiles will outperform because of its investment thesis and its characteristics that it has. And we incorporate that into sort of our forecasting, our return expectations. That's the second way. And lastly, I think within the Old Mutual ESG Active Fund, we give clients a carbon reduction in the fund of 40% or more. And that really, the way we implement that is in the way we bring stocks together in our portfolio at the end, where we target that specific carbon reduction. So it's in the portfolio construction part when we know which stocks we like, and we bring it all together, and we make sure that at a portfolio level, we're giving clients that targeted, measured reduction in. That's the three ways.
Got you. So very clear, straightforward, and of course, as you say, very particular in terms of the analysis there. But Nisha, is it the same from your point of view, especially if you're taking a look at the quantitative dynamics and indexation, which is right up your alley?
Thank you, Gugu. And yeah, it's a wonderful opportunity being here today and sharing my thoughts, of course, with yourself, my fellow panelists, and then most importantly, the audience. So I'll just step back, and I think Fawaz has obviously touched on his process and more of a quantitative approach to investment. But I mean, if you think of the ESG capabilities we manage at Old Mutual Investment Group, we have the Old Mutual MSCI EM and Developed Markets ESG funds. And these are two global offerings that are run on a very systematic and rules-based approach. And what we try and do in those particular strategies is target companies that are considered best in class. Mm-hmm. So Fawaz obviously touched on certain things, and how would you measure this? So you look for high ESG ratings or scores for these particular companies. So these are companies where you have management, where you have the company trying to be focused in terms of their effort, trying to say, let's see how we can minimize our waste. Let's see how we can reduce our carbon footprint. Let's see how we can increase equality, diversity in terms of our workforce. So these are the type of companies we'll try to get exposure to in a very systematic way. And these capabilities have attracted significant flows, I think, over the last 2 years. And Khonsi and team have done amazingly well in that regard. But it's quite evident what's happening in the SA market in terms of, you know, this flow of funds into ESG capabilities. This is happening globally. So what you've seen happening globally is there's been, I think, when I looked at a ridiculous number the other day, ESG funds had hit a record 2.7 trillion in AUM by the end of 2021. So you have to ask yourself, now, why is this happening? So you think back to COVID and the disruption and the sort of the uncertainty that the pandemic brought. And what investors have tried to say now is, listen, it's sort of reignited their interest in these companies that are prioritizing, say, environmental, social, and governance factors. And that's what we try to do. So of course in the indexation space, very systematic, very rules-based. And what we try and give our clients is clarity in terms of the methodologies we use and that what underpins the indices we track. And we've partnered with MSCI in doing this because we've done our DDs. We are very comfortable with the methodology they've sort of used to create these indices, the ratings methodologies they use. And I'll briefly touch on the key tools that they use to construct these indices in terms of the funds that we manage. So number one, you have that they look at companies and they try to assess any controversial activities that the company may be involved in. And they'll flag it and they'll say, listen, a controversy, could be anything from an oil spill to any anti-competitive behavior that the company is involved in. So that's one measure. The second tool they use is they look for something called the Intangible Value Assessment, or IVA. And this is basically a lens in terms of assessing ESG issues that companies may face in the future. Any opportunities in green tech, in clean tech, any risks in terms of how their policies are used to maybe look at toxic emissions. And then the final tool that we'll use in constructing these indices is called a business involvement screening. And as to Fawaz's point earlier on, he said, we'll try and screen out any companies who are generating revenue from, say, controversial activities, maybe gambling, alcohol, tobacco, nuclear weapons, etc. And so once this universe of stocks is identified, I think what's sort of our target and what our objective is to create an index where you have 50% exposure to each of the sectors and countries within the universe. And this ensures that we then can deliver to our clients a return on risk profile that's very aligned to that of the parent benchmark. Yeah.
And I think that's important that you underscore that, because for many of us, when we look at the headlines regarding ESG, as alluded to earlier, it has come under a great amount of controversy as well as pressure, and even greenwashing in terms of some of the measures and results that we look at there. Khonsi, perhaps you can give us some insight as to why it is that we need to underscore this kind of approach that is different from an Old Mutual Investment Group perspective, and how it actually adds to the competitiveness of these ESG-focused portfolios.
I think, when you look at all three solutions, and I'm going to bring in what Sibo also shared today from a fundamental perspective, we decided to share those today for a number of reasons. I think the first one is that all of them are able to underpin or help clients fulfill their financial plans. And that means that they're able to help them get the returns that are necessary for them to achieve those plans. If you look at in all three ranges, in Sibu's range, you've got the multi-asset range that's inflation targeted, and depending on the client need, you've got a range that you can choose from. Similarly, in Benisha's space with the core range, you've also got a number of passive multi-asset solutions that you can choose there. And also, even if you look at in the quant space, which is Fawaz's space, you've got the income fund, the balance fund, as well as the equity. So you've got options depending on what clients' outcomes are that they need. So that's the first point. The second point is, in difficult times like these, risk management has come out as something quite strong. Even in Sibu's space, you saw that they're using a lot more, they're being a lot more circumspect in terms of the companies that they're choosing and including in the portfolios.
Got you.
In this case, when you look at these two spaces, in the Sharia space, you've got pure exclusions in Fawaz's space, so certain things that they leave out. But another risk management tool that you've got in both areas is diversity, be it in the passive multi-asset in Benisha's space or in Sibu's space, where you've got different asset classes to help people ride out this difficult wave. I think the other thing that you've also got is different price points. So we've spoken a lot about how people are under pressure from a cost perspective. So it gives you as a financial planner or as a client the option to choose the price point that works best for you. And then the other thing is use. I think the solutions are relevant because we've been looking at them and looking at the flows and uptake from clients. So if, again, you start with the multi-asset space, which is Sibu's space, multi-asset's always been a mainstay in South Africa for many, many years. I think that in equity. that continues to be the case. But over the last 2 years, high equity multi-asset and low equity multi-asset bled significantly, which means it lost a lot of assets.
Got you.
But we've seen that turn. So it's back in the positive. And for us, it's pleasing. I think Sibu showed it on one of the charts that we've done well over the past 2 years in that space. And we've got a team that is relatively stable. If you look at multi-asset teams in the local industry, ours has experienced very little change or loss in terms of investment professionals. And it's quite stable. And we back them to be able to take that short-term performance and sustain it into the future. Looking at indexation, which is Benisha's space, you know, over the past 2 years, there was a lot of interest in offshore,
Yep.
and there always is in South Africa. It's another key category in the local market where people like to invest. So we expected the flows there, and you see those in the ESG trackers. But the other thing that was interesting for us was to see that our local indexation range, which is funds like the Top 40, Cap Swix, etc.,
Got you.
that brought just as much in for us, which is very surprising. That tells us that the South African investor or the financial planner actually has a preference for those types of solutions. And then the last thing I'd probably want to highlight is in the Sharia space. Over the past 2 years also, it was very difficult from income funds to get good returns. But we were using sukuks in the Sharia income fund, and that allowed us to lock in higher return rates in that particular solution than you could find in the general market. And we saw a whole host of people flocking to that solution who are necessarily not Muslim investors, but because of the return promise that they could get, they proved to be relevant.
That's an interesting factor that I'd like us to build up on, because I guess it, number one, tells us that there's a consciousness within the investment community to prioritize ESG investment and looking to make an impact. But of course, perhaps at times when one is in a tough situation and experiencing volatility as we are, there's this perception that investors will prioritize return over any kind of impact that we're trying to derive. And I guess the question that I'm asking on behalf of the audience today is, what happens in an environment where investors actually say, well, I'd rather prioritize getting a solid return instead of making a difference in the world? Does there need to be a trade-off between the two following the performance of your portfolios that you've witnessed? Quincy, but it's open.
I'll have a first stab, and then I'll probably hand over to Fawaz.
Sure.
I think it's very important to understand the return promise of ESG. The return promise is to give you the same or a competitive return as you'd get from any other fund. But what makes it a preferable investment solution is if you can do that and get the same while having a more positive impact, why would you not do it? It's almost a no-brainer.
Gotcha.
So that's the return promise of it. Fawaz can speak more as to whether, in his experience in the funds that he manages, he's actually seen ESG resulting in less returns, actually.
Yes, absolutely. And I mean, the short answer to that is investors do not want to give up financial return for doing good. Like financial return, everyone wants to do good. I think I can wholeheartedly say that, but you don't want to sacrifice your return for that. And, based on our analysis, we've shown that it's actually additive to return over the long term. There's many studies over the world that shows, depending on which studies you look at, but there's many studies that shows ESG over the long term outperforms. And based on our analysis in the SA market, it definitely shows slight outperformance. But the key is it shouldn't cost investors a financial return by doing good for the people and the planet. And I think it's really a tale of two tapes. If you look at the period preceding COVID, it's really ESG funds for the 7 or 8 years before that. It's done exceptionally well and consistently, not only in all over the world, in most regions. And it's really, based on the macro events, Howell and Sibo painted a picture on, all the Ukraine-Russia war, the oil prices running so hard. these last 2 years have been kind of tough.
Not
with-
for your portfolio, though. It actually launched in the middle of the pandemic, 2020, and looking at the outcome so far, as at the end of May, it actually did fairly well.
Against that backdrop, absolutely, absolutely. It's not, I mean, it's there or thereabout the relative to the benchmark we're trying to beat, but also in the terms of the general market, it's stacked up quite well. It's sort of middle of the pile, which we'll take given the environment and given what we're promising to investors from an ESG objective. And just very quickly, we're promising investors a significant ESG profile in terms of the kind of companies we hold. We're looking to hold companies that rate much higher on ESG than the general benchmark. And we're also giving clients, I think I touched on it earlier, at 40% carbon reduction. So given that, and being sort of in the middle of the pack in these tough times, I mean, the fund launched 2 years ago, slap bang in the middle of this oil run and the fossil fuel
Exactly.
run. We'll take that.
What's interesting that I do want to build up on, though, is that you don't have Sasol, as you mentioned, in your portfolio, more towards Anglo and Impala Platinum. And there's this perception in the market when it comes to the selection of stocks to keep in an ESG portfolio that if it's in commodities or resources, which have actually done incredibly well over the last 2 years, that it's a dirty stock and shouldn't be incorporated into the portfolio. So I guess help us understand from an Old Mutual Group point of view the assessment of stocks, specifically those within your portfolios that do speak to the ESG theme and in some circles might be considered dirty, but as Sibo also mentioned in his earlier presentation, you need to look at the full value chain of ESG. Benisha, perhaps if you can kick off on this one to give us a response.
If I can just perhaps add to
Sure.
Fawaz and Khonsi's answer in terms of, returns and ESG. So within the indexation space, as I mentioned, we manage the MSCI World and ESG Leaders funds, and those funds have actually performed in line with the actual parent benchmarks. And if you look at the underlying construction, and as I mean, in my previous answer, I talked to best in class. In the construction of those particular indices, we're going to try and target, as I said, a sector and country neutrality. So we don't have the skill within the indexation space, rightly or wrongly, to actually make these picks that maybe a Sibu or a Fawaz could take. But what we're guaranteeing a client is that we're confident that the methodologies we use are sound in terms of giving a client the sector and the country sort of exposure that's very much aligned to the top level parent benchmark.
Gotcha.
And in doing that, we've seen, like over, I think, the last 3 and 5 year periods, both the DM and EM ESG Leaders index funds have actually performed very much aligned to the underlying parent index. So talking about these dirty sort of industries, if you want to term it that, Google, and if you just think about what I've said in my previous sort of sentence, the sector neutrality. So when you invest into these MSCI Leaders indices, funds that we manage, you're going to get exposure across all the different gig sectors. And that means you're going to get exposure to your resource counters, to your energy counters. But what we'll do is we'll be selecting counters that have higher ESG ratings, which are then obviously dependent on those pillars I talked to, the controversies measures, the IBA measures, and the business screening measures. So, for example, we wouldn't hold a Shell because we believe that looking at their different metrics in terms of how they manage toxic emissions, in terms of how they compare to their peers, they're less favorable to hold Shell than it is a total. But there you have it. You have energy exposure, you have resource exposure, but you just are investing in the better half of these sectors.
Got you. In comparison to their peers, as well as you say, the
Yes.
better half of the sectors, which tells us something that you're also, I guess, looking at leaders within that particular space who could influence other players within that environment, and those essentially then lead to a greater change within the environment. I do want us to double check with the audience if there are any questions regarding ESG and, of course, any concerns that might lie there. A reminder that you're more than welcome to raise any of your questions and we'll get a roving mic to you. But coming back to the dynamics that we, of course, have highlighted, and the big question that many of us might be anxious and uncomfortable about is the sustainability of the returns that we see from the ESG space, especially against the backdrop of this global energy crisis. Where to from here? And what particular nuances do we need to be cognizant of as we continue to look for return, but of course also making a difference in the market? Fawaz, maybe let me put you on the hot spot.
I'll take that. I mean, in the last 2 years, we've seen some concerns, and we're actually seeing some money flow out of ESG funds, given the phenomenal run it's had in terms of asset inflows over the last 5, 6, 7 years or so. And people are chasing returns. Naturally, we want the highest return, and it happened to be sort of, the Panisha mentioned the term dirty industries, or the oil industry, fossil fuel industries that have been booming of late in terms of returns. And there's a lot of sort of skeptics saying now, we can't just cut these industries out. We'll be sacrificing returns that's coming from our pockets, But things always normalize. They always normalize. I mean, it's not possible for the oil price to continue shooting through the roof, and it will stop at some point when things normalize in Russia and Ukraine, whenever that may be. But yeah, it's not sustainable, and it will come back, and hopefully in sort of the short to medium term, we'll have less of these black swan events. And when that happens, the investment thesis and the case for doing good for the people and the planet, and ESG companies possess certain good traits, such as they keep their staff longer, their staff are happier, they look after their people. Their cost of capital is lower, their cost bases are lower. They're investing in they're investing in the future in terms of the energy usage, and the costs are lower. So these all should translate to being more profitable over the longer term. And that will come through when one looks through all the short-term sort of volatility that we find ourselves in.
Got you. And a valid point that you raised there, because it also increases, I guess, the amount of analysis, outcomes, and research that we need to apply to businesses, as well as we've seen greenwashing also becoming a key theme and concern there. How does Old Mutual Investment Group approach this then? Are there one-on-one conversations with leaders within these companies to hold them to account to the outcomes, the measures, and the data that they're actually releasing to the public? Fonse?
I'm happy to take that. I think there's increased scrutiny around responsible investing in ESG in South Africa, and we welcome that as a company. I think it's important to, the way we look at it, and I'll speak to 3 parts. The first is, I'll share with you how we implement and evidence responsible investing. Then I'll speak to a couple of other almost sanitary factors that you have to keep in mind when thinking about this subject. And then lastly, I'll speak about broader recognition. In terms of implementing and evidencing, we've got various ways that we implement ESG. One of those is through stewardship, which is where we've got people like Nicole, who's recently joined the team, and before her we had Rob Lewinson, who's now our head of ESG after John Duncan departed, and they're steward professionals. They go and they vote at various AGMs on behalf of our investors, because behind them we've got a lot of capital to be able to sit and have a vote at the table at these companies. And every year we'll publish a stewardship report that shows you exactly what we voted for, were those votes successful or not, etc. So a person can get comfort. That's a good example of how you evidence it.
Gotcha.
The other way that we're able to do it is in Benisha's space through the ESG ratings or the scores that the different companies get. If you look at our MDDs or our fund fact sheets, you're able to see the actual ESG rating of a particular fund that we've got. The other one I'd like to draw a bit of attention to is regulations. So you've got the EU SFDR, which is out there now. It's the European Union Sustainable Finance Disclosure Regulation. And there, they have grouped funds into different articles. And you go from Article 6 all the way up to Article 9. And those different articles are different expressions or levels of commitment to ESG in a particular solution. The 2 ESG trackers that are global that Benisha manages are Article 8. That was introduced to try and create a level playing field so that people don't claim to have certain ESG credentials over others. This is where you can compare them all together.
Would that matter, though, especially in economies where the dynamics are not the same? South Africa is an emerging market versus our developing market peers, right? The social dynamics are not similar. Governance issues, we know, are also fairly different. Would that matter when it comes to the evaluation of those particular outcomes?
Absolutely, because most of these, the articles apply when you go into the global sphere.
Yeah.
And there, so whether we're South Africa launching a fund that operates in the global space, or it could be America doing the same, etc., it creates that level playing field still, so that you can be able to measure accordingly. So that's how we evidence, implement and evidence. The second thing, which has been discussed today, is when thinking about this, people normally are at polar opposites. People could sometimes think if you talk about responsible investing, it means you have to be either doing like CSR type work only, or that you can't hold the oil companies, which we spoke. You can. You can hold the ones that are relatively better from an ESG perspective than others, than their peers. It's relative to peers. I think the other important thing to note around ESG is there are varying levels of expression. That's very important from a client perspective, because we differ as clients. Some people might have high conviction, others lower. Others might just be chasing a return, and ESG might be a feel-good factor, whereas others might be saying, listen, I'm actually willing to give up a bit of return to be able to get certain outcomes. If you look at our range across the investment business, a light version could be perhaps the Sharia space, which is where Fawaz is operating, where we've only got exclusions. If you take it one step further, you've got Benicia solutions that use the exclusions plus the ESG ratings. On the far end of the scale, if you look at one of our affiliates, which is Old Mutual Alternative Investments, there you can go full-on impact investing, where you're either building a piece of infrastructure or something like that. So it's important to understand that continuum. And then the last thing around this controversy around ESG is also broader recognition. So don't only take my word for it in terms of me saying that we're good at it and we're the real deal. If you look at recognition that we've received globally, we've received an international award last year, and we've won the same award again this week, we found out. So we've won it 2 years in a row. And we also got recognized locally by 27/4, along with 2 other asset managers for our credentials in the space. So I think when you look at it holistically in that way, you're able to get some comfort, and we certainly are comfortable with what we do, and we'd like our clients to be confident in our credentials in the ESG space.
Yeah, for sure. And I think quite refreshing to hear, as you say, remaining as a global leader, receiving that acknowledgement and recognition, essentially saying that we are globally competitive as Old Mutual Investment Group. I'm aware that we've got just under 2 minutes to wrap up this conversation, and of course, tying it back to the major question as to how it is that we implement responsible investing in a systematic approach, even when there's this much volatility in the market. I do want to gauge if there are any questions once more. We're more than happy to take your questions. About a minute. Your hand has been noted, sir, and the mic is making its way to you. Your hand has also been noted, sir, and we'll come to you. Perhaps if we can start with your question, sir, if you could introduce yourself, and then we'll come to you, sir.
Hi there, I'm Jeremy Rice. Just a question around the crossover between ESG and Sharia compliant funds. To what extent is there a crossover? How much ESG is in Sharia, and how much Sharia is actually in ESG? Just an idea.
Yes, that's a very good question. Where the crossover occurs is really in our investable sort of subset of shares that we consider. And what we do on the Sharia side is there are certain industries that's an absolute no-go. As I'm sure you're aware, industries such as alcohol, tobacco. In fact, the whole of the financial sector as well is stripped out because of the high interest component, and interest, traditional interest is obviously not allowed. But the intersection comes in that screening of companies. I think I mentioned earlier within ESG funds, and within our ESG fund, We screen out certain industries such as alcohol, tobacco, but also gaming, fossil fuels, weapons manufacturing. But the intersection is really in the alcohol, tobacco, weapons manufacturing. So immediately the subset of investable shares look sort of similar, barring the financials sector. ESG funds, we can hold financial shares. Sharia funds, that's excluded. And that's obviously a big sector within the dynamics of South African market. But it's really from a moral and ethical standpoint, and from an investor belief system standpoint, it's really saying, I have this amount of money to invest. However, I don't want to support companies that operate in these industries as it doesn't align with my beliefs. And we find that intersection between BTI, for instance, nice practical example, it's quite big in terms of market cap in the South African landscape. It's about 5%, and stand corrected, of the entire JSE All Share Index, for instance. And that's cutting out 5% of the market cap immediately, that we're saying we're just not going to go there. So that's the similarities in that regard from a practical perspective.
Got you. Thank you for that question there, sir. You can go ahead with your question, sir. If you could please introduce yourself.
I am Ishak de Toy, and basically I would like to ask Fawaz and maybe Bernice as well, if you would consider investing into companies that build nuclear power stations in your portfolio. Would it comply with Sharia compliant funds? And also, if you buy a majority share of, say, 51% in those funds, whether it's a company that builds nuclear power stations in South Africa or internationally, and that is where Bernice comes in, can you bring it to South Africa as we need electricity here?
So right
Valid
now,
point.
thank you. I'll just briefly answer, and then you can take over for us. So in the current sort of scheme or methodology underpinning the ESG leaders indices, I talked about business involvement screening. So these are obviously your companies generating revenue from controversial sort of business lines, and one of them, unfortunately, is nuclear weapons. So in our current mix, or in our current sort of index range, the universe that we'll be investing in that doesn't, unfortunately, include nuclear-powered or nuclear companies at the moment.
Yeah, I think let me add on to that. So it will have to be screened for ESG, if it's fit, if it operates in ESG compliant industry. And I mean, as Benisha mentioned, it's generally nuclear orientated industries are not, it's not mainstream to be included. I get your question around, how are we using that nuclear in terms of transitioning to, away from fossil fuels. But yeah, we'll have to assess it. When it comes, I think it's very important to note also, we are particularly in the listed space. So our investment subset are shares listed on the JSE, for instance. And once that share comes into sort of, firstly listed onto the exchange, we don't have any shares like that at the moment. But if a new share comes into that space, we then put it through our frameworks and assess. I think when you're looking at sort of smaller nuclear projects, Khonsi touched on the spectrum where you can go into the more direct infrastructure type investments, which sits in one of our other divisions within Old Mutual Investment Group, and they would have their own framework for assessing whether something's green, or whether it's assisting in the green transition.
Got you.
Okay.
I hope that does respond to your questions, sir, but thank you to the both of you for sharing those questions with us. I'm aware that we've run out of time, but Khonsi, I'd like you to wrap it up for us very briefly, because we know that we're taking these conversations back to our clients who are anxious, uneasy. We know that we're going to tell them to stick to their knitting, time in the market versus timing the market. But at the same time, this might be an appropriate opportunity for us to say to them, hold on, we're not racing to find a quick return here, but let's introduce responsible investing and ESG investing to your portfolios. What should we be mindful of sharing with our clients at the end of the day to fully comprehend the full value of ESG incorporated in the various funds and portfolios we have?
I think I'll probably talk to it from a returns perspective. So ESG offers you two things. If you look at from a fundamental perspective, we've always had the traditional metrics that you'd look at to rate a company. Price to earnings ratios, etc. ESG is additive. It's an additional factor that we're now introducing, and that can only strengthen the case. I think people always look at it and say, oh, maybe, you know, you're removing value or you're removing the potential for more returns. And I think one of the ways where you can evidence that or show that is in Benisha's EM fund, the global EM fund, where actually there is a return anomaly where that fund outperforms its parent index. So the leaders is doing better than the normal MSCI EM index. And that's probably because of disparities between emerging market countries in terms of their regulation and ESG scores. You get gaps. Certain countries and sectors are really strong and jacked up, and others still have a way to go to get there. So that's where you're able to find that value. I suspect you'd find very similar when you looked at just a well-run emerging markets fund. So I don't think it's only the case with us from an ESG perspective. But I suppose the last point for me is, in difficult times, I'll go back to risk management. Risk management becomes very, very important. And again, there, ESG is another sort of factor that you add in from a risk management perspective to make sure that you're as strong as you can be. And there, we're able to see it in our range. We've been through periods where we've seen global portfolios really take a beating. And when we see that across our entire global range, we'll always see that the ESG funds that are global don't fall as much as the normal vanilla ones. And similarly in SA, which I think you alluded to with Fawaz, when SA tanks across all of our portfolios, the ESG version of our local capability is the one that holds up better. So there is downside protection, quite a lot of downside protection. So ESG can give you both. I think it's something that we're going to, that will benefit us if we include into portfolios. I don't think it's a case of you've got to go sort of all in, but it's going to be something that we're going to hear more about in our lives. And if we use it tactically, it can give us the right sort of balance in our portfolios and for clients also.
Got you on that one. As Sibo might have mentioned in his earlier presentation, I think we could all drink to that, but we're also cognizant of it not falling into all portfolios here, tying into Sharia as well as ESG investment. I think some solid insights that we've all been given, and of course some information that we can take back to our clients as we look to broaden their understanding and expectations of ESG investing and how it can be implemented systematically. Thank you so much, Fawaz, Benisha, as well as Khonsi. Really appreciate the insight that you've shared with us today.